Hello everyone, Professor Christensen here. Today we're going to take a look at some simple financial statements. So this is appropriate if you have very little experience with financial statements at the beginning of, say, a financial accounting or an accounting principles class. Our information that we're going to be using is here up on the screen. We have Chamberlain Company that began business on January 1st, 2018. Our financial information is shown to the right. And we're going to prepare an income statement, a retained earnings statement, and a balance sheet. So here are all of your accounts, and we want to create good habits because in the future you may have more and more accounts when you start to make a little bit more complex financial statements. So the first thing we're going to do is we're going to classify each of these items as one of these 5 financial statement items. It's either going to be an asset, a liability, equity, revenue, or expense. That's going to make it easier for us when we start to do the financial statements. Okay, so let's start with accounts payable. Accounts payable is a liability. Remember that liabilities often have the word payable, and payable means that the company has to pay something, money, to someone else in the future. Okay? All right, so now I'm going to ask you to pause the video for a minute and continue this process. See if you can label each of these rest of these accounts as asset, liability, equity, revenue, or expense, and then come back and let's see how you did. Okay? All right, so pause the video and then come on back. Okay, so hopefully you paused the video. And let's go through and see how these accounts are going to be classified. Accounts receivable sounds like accounts payable, right? But instead of paying money in the future, the company is going to receive money. So accounts receivable is an asset. Cash is also an asset, right? Cash is a resource. Remember, an asset is a resource owned by the company that's going to have future benefit. All right, common stock. Hopefully you said common stock is an equity account. Common stock represents the money that stockholders or the owners have paid into the company, the investors. All right. Dividends is also an equity account. Remember that dividends are amounts that the company pays to its stockholders. And now we have equipment. Equipment is also an asset. Hopefully you got that right. And then remember what we said about payables. Payable tells us that it's a liability. It's money that we're going to have to pay in the future. A note payable is a little different than an account payable because it has an actual note. So somebody signed the note and said, I'm going to promise to pay you back $14,000 in the future, and they're going to have some interest with that. Okay, next up is rent expense. Hopefully you said that's an expense. Most items that have the word expense in them are going to be an expense unless it's a prepaid expense. We don't have any of those here, but you'll probably see them in the future. Okay, retained earnings is an equity account. Retained earnings is exactly what it sounds like. Retained means it was kept, and earnings is like net income. So retained earnings is the money that the company has kept and not paid out in dividends. Now notice this has a zero balance. The reason it has a zero balance is because it is the first year of business. So once we get past this particular set of financials, it'll never have a zero again. Okay? So generally you're going to have a beginning balance there. All right, next up is salaries expense. Again, that's an expense. Service revenue is revenue. Supplies, and we have supplies expense. So what's the difference between supplies and supplies expense? I'm going to just format these all the same. Supplies are the items that are left at the end of the year. So that's what you still have left, and supplies expense is what you used. So supplies are an asset, and your supplies expense, of course, is an expense. Okay, so now we have all of our items classified. That's going to help us a lot when we start our financial statements. Now let's come over here and review what goes on the different financial statements. So the income statement shows us revenues. Sorry about that. 1 minute. Revenues minus expenses equals net income. And remember that it also could be a loss, and a loss would be a negative number, meaning your expenses were greater than your revenues. And in accounting, we often show negative numbers with brackets like that. So that bracket around the loss means it's negative. Okay, so our retained earnings statement shows our beginning retained earnings, right, plus our net income. Remember that you have to do the income statement first because you need the net income from the income statement in order to do the retained earnings statement. And all three of these statements are related. The net income from the income statement is going to go on to our retained earnings statement. And then the ending retained earnings is going to go into the balance sheet. And we'll see that as we go along. So our retained earnings is beginning retained earnings plus net income minus dividends. And that gives us ending retained earnings. Okay, that's our retained earnings statement. And then finally, we have our balance sheet. And on our balance sheet, we see what we sometimes call the accounting equation. Assets equal liabilities plus equity. In our case, we have a corporation. We have common stock, so our equity is going to be stockholders' equity. You could be studying a sole proprietorship, in which case you'll have a different kind of equity. You'll have capital. Okay, so let's start our financial statements. So we're going to start with the income statement. We're always going to have a heading because remember, somebody's going to be looking at this and they're not going to know what the company is or what the period of time is unless you tell them. So we're going to call this Chamberlain Company. This is going to be our income statement. And this is our calendar year of business. So we're going to say for the year ended December 31st, 2018. Okay, so remember what's going on our income statement, revenues minus expenses. So first we're going to have a category called revenues. And we only have one kind of revenue here, and it's service revenue. And our service revenue is equal to $50,000. Now, I'm going to highlight this. If you're using a piece of paper, you can check it off. I would highly advise that as you do these problems, check off the items as you use them, so this way you don't forget anything. Okay, because all of these will be used by the time we're done. All right, next up are our expenses. And what order should we put our expenses in? Let's think about it. What would make sense? Would a reader of financial statements want to see the teeniest, tiniest expense first, or would they want to see the most important and the largest one? So we're going to give them the largest one first. In this case, it's salaries expense. And I'm going to put the expenses on the left, and we'll see why at the end, so we can add them up, and it'll be a nice, neat subtraction over here on the right. Okay, so our salaries expense is $20,000. Our next largest expense is going to be rent expense. We'll put that next. So rent expense is going to be $8,000. And then our final and smallest expense is supplies expense. And our supplies expense is $3,400. And then again, I'm going to highlight that to remind us that we've used it. All right, so now we're going to have a line that says total expenses. And I'm going to add up these three numbers. Okay, so it's going to be equal to this plus that plus that. So add up all your expenses. And then remember, revenues minus expenses equals net income. So you see, I put these over to the left, so this way it's very easy for a reader to see revenues minus expenses equals net income. And then we'll put loss in parentheses. But in this case, we do have net income. We have revenues minus our expenses. which is in H14. Okay, so there we are with our income statement. Everything's all in order, and we have $18,600 in net income. All right, so next up is our retained earnings statement. Our retained earnings statement is going to have the same heading, the same date as our income statement. So it's going to say for the year ended. The retained earnings statement shows us what happens over a period of time. All right. And we're going to start with our retained earnings on January 1st. That's the beginning of the year. All right. In this case, our beginning retained earnings is 0, remember. All right. Now we want to highlight that so we remember that our retained earnings from there is gone. Now we're going to add our net income. And our net income, what is it? It comes from our income statement. That's where we get our number from. So I'm going to just highlight this with an orange color to remind us that the net income comes from our income statement. Okay? And then we're just going to call this a subtotal. And the subtotal is equal to those two added together. And then we're going to subtract our dividends. Don't forget to subtract them. And our dividends are equal to $5,000. I'm going to highlight dividends to remind us that we use them. And then this gives us our ending retained earnings. So retained earnings, December 31st, 2018. And this is going to be equal to the 18,600 minus the 5,000, so 13,600. All right, so now we have 2 of our financial statements done. And if you look up here, you're going to notice that everything that's left is either asset, liability, or equity. Okay? All right, so let's go down to our balance sheet. Let me just insert some rows here so that we can move the data down so we don't have to keep going back and forth. Okay. Now I better let me add a few more lines so this way we can have everything right in front of us. Okay. All right. So now here is our data for the balance sheet. Now our balance sheet, again, we're going to have Chamberlain Corporation. Company, I'm sorry. And instead of for the year ended, a balance sheet is a snapshot at a point in time. So our balance sheet is just going to say December 31st, 2018. Okay. Okay, so now, first thing is assets. And on our balance sheet, our assets are listed in order of liquidity, meaning the most liquid, the easiest to turn into cash, comes first, and then the least liquid later. This is US GAAP. If you are looking at international statements, it's a little bit different. Okay, so our most liquid asset is always going to be cash. Sometimes it's called cash and cash equivalents. And remember, our cash was $6,200. Again, we're going to highlight that so we know we used it. All right, we have accounts receivable, equipment, and supplies. So accounts receivable, generally speaking, depending on the credit terms of the company, they're going to be collected in around 30 days. So that's going to be our next most liquid asset. And that is $4,000. I'm going to highlight that. And now we have equipment and supplies. So supplies are little things like, there could be office supplies like pens and pencils or toner for your printer, things like that. And equipment is generally things that are bigger. It could be machinery, it could be desks and furniture, but equipment lasts a long time and supplies generally will be used up within a shorter period of time. So since we're going in order of liquidity, we're going to put supplies first. That's $3,800. I'm going to highlight that. And then we're going to put our equipment. And our equipment is $53,600. Okay, so now all of our assets are done, so we're going to call this total assets. And the total assets is going to be the sum of these numbers here. Okay, so our total assets are $67,600. Remember that our assets have to be equal to our liabilities in equity, so that's what we're going to see next. Okay, so now we have liabilities and stockholders' equity, because remember we have a corporation, so we have stockholders. All right, so let's list our liabilities first. Okay, so we have two liabilities. We have notes payable and accounts payable. So most of the time you're either going to put your largest payable first, or you might put notes payable first. In this case, notes payable is also our largest, so we're definitely going to start with notes payable. And our notes payable are $14,000. And then, oops, I meant to highlight that, but that didn't work. And then we're going to do our accounts payable. And our accounts payable are $10,000. Let's highlight our accounts payable. And then we have our total liabilities. Our total liabilities are notes payable plus accounts payable. Okay, next up is stockholders' equity. And for the most part, our stockholders' equity for now is going to only have two accounts. It's going to be common stock and retained earnings. Okay, so first we're going to put in our common stock. Oops. And our common stock, I'm messing up here. Let me do that again. I'm just going to type it in. It's easier. Our common stock is equal to $30,000. And then our retained earnings, this is very, very important. Our retained earnings has to come from our retained earnings statement. If you remember to highlight this or check it off as you use it, then you won't be tempted to use that. Number one mistake that students make when they're preparing a balance sheet is they use the wrong retained earnings. Okay, so don't do that. This is retained earnings for the end of the year, and that comes from our retained earnings statement. Okay, now I'm going to highlight this in, let's say, green, and I'm going to highlight this in green to remind us that the retained earnings has to come from our retained earnings statement. Okay, so our total stockholders' equity is these two added together, which is going to be $43,600. And now we're going to cross our fingers, and we hope that our liabilities plus our stockholders' equity are equal to total assets. So this is equal to the $24,000 plus our H45, our stockholders' equity, and lo and behold, we have $67,600. So we're happy. Our balance sheet is in balance. I'm going to also highlight this number to remind ourselves which numbers on these financials have to be equal. So the total assets must equal your total liabilities and your stockholders' equity. Our retained earnings on our balance sheet came from the retained earnings on our retained earnings statement. And remember that net income on our retained earnings statement came from our income statement. Okay, so that's all we have for today. That is the basics of financial statements, and I hope you find it helpful to your studies.